Welcome to this week's edition of Macro and Flows from Orestes Capital for the week ending on June 5, 2026. We're Elena and Marcus.
Right now, if you listen to the consensus across the street, they are telling you that the recent market volatility is simply a sharp, narrow unwind.
Yeah, or a rotation on cue.
Exactly. I mean, it sounds orderly, it sounds completely manageable, but beneath the surface, our proprietary modeling is flashing a decidedly different structural warning.
Well, we're seeing systematic algorithms sitting less than 1% away from an automated catastrophic sell-off. So today, we are filtering out the noise. We're going to examine exactly why the prevailing narrative is dead wrong.
And we'll cover how the actual plumbing of the market is turning structural shock absorbers into amplifiers.
Precisely. And most importantly, what this late cycle exhaustion means for your portfolio.
So to understand the immediate noise, we really must first establish the underlying structural regime. Look, the prevailing narrative treats every daily price movement as an isolated fundamental event.
Which is a fundamental misunderstanding of market mechanics.
Completely. Markets operate in highly defined mathematical regimes, and our internal factor signal, the OCM-PCA model, confirms that we are firmly entrenched in a euphoria or reflation regime.
And the 5-year and 3-year rolling windows unanimously confirm this state. I mean, this is not a transient spike based on a single headline.
No, it's a structurally robust environment that is currently being pushed to its absolute physical limits.
Let's actually demystify what the OCM-PCA model is, just so you understand exactly what we are measuring here. PCA stands for Principal Component Analysis.
Think of it as an economic MRI.
Exactly. When you look at a standard stock chart, you are only seeing the skin-deep price action, and that action is heavily distorted by daily noise and retail sentiment.
But the PCA model filters out that daily noise. It isolates the underlying engines, the principal components, that are actually driving asset prices across the globe.
It strips away the distraction, really, to show us the core macro forces at work. And right now, that MRI is showing an engine block running at extreme, unsustainable heat.
That is the precise operating condition. Let us isolate the first primary engine, PC1. This measures global growth. It is currently reading at the 89.7th percentile.
Carrying a z-score of positive 1.12.
Correct. And to put that in context, anything breaching the 80th percentile triggers our structural euphoria threshold. The primary upside contributors driving this metric are operating at outright extremes.
Yeah, we are seeing standard deviation readings in copper at positive 2.71.
And in emerging markets at positive 2.7. Concurrently, PC2, which measures rates and reflation, is holding remarkably steady.
Which is being driven by sustained upward pressure on global sovereign yields, specifically the German 10-year and the U.S. 10-year.
We also need to factor in the velocity of this movement. We are tracking a massive large plus impulsed rally in growth velocity.
The week-over-week change aggressively shattered our upper bound thresholds. I mean, this trajectory is heavily driven by foreign exchange and equity spread mechanics.
Primarily the Korean won against the US dollar.
Yeah, and the spread between small cap and large cap equities, which is operating at an extreme positive 2.17 standard deviations. But this actually brings us to a glaring contradiction in the prevailing narrative.
The disconnect between the data and the street.
Exactly. How can market intelligence call this a modest equity pullback when our model shows standard deviations operating well beyond extreme levels? A positive 2.7 standard deviation in copper is not a normal bull market.
It is a statistical outlier. And that contradiction is exactly where the systemic risk lies. The street is interpreting recent price action as a healthy start to a new cycle, a standard rotation of capital.
But the structural data dictates otherwise. Calling this the start of a cycle is like showing up to a marathon at mile 25 and stopping to tie your shoes.
That's a perfect analogy. When underlying variables operate beyond 2 standard deviations, it physically indicates exhausted positioning.
It means that virtually every available dollar that can buy into these pro-cyclical trades has already bought in. The room for new marginal buyers is virtually non-existent.
Precisely. This is a late cycle exhaustion point.
So if the OCM-PCA model indicates an exhausted euphoria regime, our next logical step is to identify who is currently positioned at the edge of this cliff.
Right. If we were at mile 25, who is holding the baton?
We have to divide the market into 2 distinct groups of actors to understand the capital flows here: systematic traders and discretionary retail investors.
Let's start with systematic traders, heavily represented by commodity trading advisors, or CTAs. They do not make qualitative judgments about a company's forward earnings or balance sheet health.
No, they are computer-driven trend followers. They operate purely on mathematical signals.
Buying when moving averages rise and liquidating when they drop. The models are entirely designed to capture momentum.
And right now, market intelligence confirms that those systematic trend followers were being heavily long in equities across all major global regions.
They have bought the momentum all the way to the top. However, the critical detail here is their margin for error. The cushion before their programmatic sell signals are triggered in the US is now incredibly thin.
We are looking at a downside cushion of less than 1%.
Less than 1%. Meaning, if the broader market dips by a mere fraction of a percent, these algorithms mechanically pivot from buying to selling.
And this liquidation happens entirely independent of fundamental news or economic outlooks. It is a purely mathematical trigger.
Consider what that means when you contrast that systematic exposure with the current behavior of regular retail investors. Broadly speaking, the retail base is beginning to retrench.
Yeah, we are observing consistent outflows from monthly equity funds. The everyday investor is quietly stepping back from broad market exposure.
But they are not moving entirely to cash. Instead, they're concentrating their risk in highly specific, volatile pockets.
We're tracking continued massive inflows into memory themes, specifically DRAM and Korean equities tied to the Kospi index.
And more concerningly, retail capital is flowing heavily into meme stocks with exceptionally high short interest, places where structural squeeze risk is building rapidly.
That intense bifurcation in retail behavior, that is a textbook late cycle indicator. Broad market participation narrows significantly, and speculative capital chases highly concentrated, high beta momentum trades.
So you have a retail base that is shrinking its broad footprint, running parallel to systematic machines that are fully loaded with long positions.
Sitting just basis points above their automated sell thresholds. Let's pause and consider the mechanical reality of this setup for your portfolio.
If systematic CTAs are effectively driving the market, but their margin for error is less than 1%.
And the broad base of retail investors is quietly stepping back. Who is left to catch the falling knife if the trend breaks?
Exactly. If the algorithm's moving average crosses and the machine says sell, there mathematically must be a buyer on the other side to absorb that liquidity.
And if the retail shock absorbers are absent, the resulting price drop is not a slow decline. It is an immediate, severe air pocket.
Which brings us to the core structural question. What is the catalyst that actually pushes those systematic algorithms over that 1% edge?
That catalyst inevitably stems from the macroeconomic and central bank backdrop. Look at the deeply conflicting economic data the market was forced to digest this week.
We received a remarkably strong Friday payrolls report that signals a robust, tight labor market and persistent inflationary pressure.
Yet, this was immediately contrasted with a benign CPI report suggesting consumer inflation is actually cooling.
You might logically assume that a strong labor market is the ultimate safety net for equities.
But in this specific regime, conflicting data traps the central bank. The focus now shifts entirely to the upcoming June FOMC meeting.
And market intelligence flags a highly probable outcome for that meeting: the central bank's elimination of forward guidance.
We need to translate what that actually means for the flow of capital. Forward guidance is the central bank's way of giving the market a definitive roadmap.
It tells institutions exactly what the Fed plans to do with the cost of money over the next 6 to 12 months.
Eliminating that guidance means the central bank is taking away the steering wheel. They are forcing the largest capital allocators in the world to drive in the dark.
And driving in the dark systematically raises interest rate volatility. When the forward roadmap is removed, every single data point, every weekly jobless claim, every manufacturing print
becomes a potential policy pivot. The market is forced to reprice the probability of rate hikes or cuts in real time every single day.
Let's explain why higher interest rate volatility acts as a mechanical headwind for risk assets. Interest rates represent the basic cost of money.
And large institutional players do not trade with cash. They operate on massive leverage, borrowing money to finance their positioning.
When the cost of that money becomes highly unpredictable, the risk management models, specifically the value-at-risk models at these institutions, force them to shrink their risk footprint.
They are mechanically forced to sell assets to reduce their overall exposure simply because the cost of carrying that risk has become too volatile to accurately model.
It has absolutely nothing to do with whether they believe a specific tech stock is a good 5-year investment. It is pure, unemotional balance sheet math.
Precisely the dynamic we are tracking.
Yeah.
And when macro policy forces these massive institutions to adjust their risk footprints, the actual plumbing of the market dictates exactly how violent that adjustment will be.
We saw a stark preview of this plumbing in action this past Friday. Market intelligence recorded heavy future selling.
A massive $21 billion net sold in U.S. equity futures.
But the volume itself is only half the story. The other half is the mechanism amplifying that volume.
This requires us to completely demystify levered ETF rebalancing. Let's use a clear analogy here. Imagine a standard exchange traded fund as a traditional shock absorber on a car.
When you buy or sell, the ETF provider manages the underlying assets steadily, absorbing the bumps.
But a levered ETF, for example, a fund mathematically designed to deliver 3 times the daily return of a technology index, cannot act as a shock absorber. It is structurally impossible.
If the market drops 1%, the levered fund drops 3%. Its total asset base shrinks, but its mandate dictates it must maintain that exact 3 times leverage ratio.
To maintain that ratio on a suddenly smaller asset base, the fund is mechanically forced to liquidate underlying holdings into the close of the trading day.
Instead of absorbing the shock, they act as mechanical amplifiers.
They pour gasoline on the fire right at the closing bell.
That stress in the market plumbing is also highly visible and quantifiable in the options market right now. We are closely monitoring the implied volatility spread between the NASDAQ 100 and the S&P 500.
Currently, that specific spread is breaking out. It's hitting the 99th percentile on a 20-year look-back.
The NASDAQ 100 implied volatility is trading roughly 10.5 basis points over the S&P 500. This is a profound structural dislocation in how risk is being priced.
To understand why a 99th percentile dislocation matters, we have to look at the concept of dealer gamma. Again, we're going to translate Wall Street mechanics into plain English.
Market makers are the middlemen who facilitate trades. When you buy a put option to protect your portfolio from a drop, the market maker sells it to you.
But they do not want to take a directional bet on the stock market crashing. They immediately hedge their own risk by shorting the underlying stock.
This hedging process is governed by a metric called gamma. Think of market makers like insurance companies writing hurricane policies.
In a calm season, they collect premiums, and their hedging acts as a shock absorber. If the market dips slightly, the math forces them to buy, steadying the price.
But when a Category 5 storm hits, when volatility spikes and spreads blow out to the 99th percentile, the math brutally flips.
Dealer gamma transforms from a shock absorber into a massive amplifier. If the market begins to drop, the middlemen are forced to aggressively short the market to hedge their rapidly expanding risk books.
Which deliberately accelerates the drop. Connecting this complex plumbing back to your individual portfolio is vital.
What this means in practical daily terms is that intraday sell-offs can and will accelerate violently into the close, completely disconnected from fundamental news.
The selling is driven entirely by the strict mathematics of market makers and systemic ETF rebalancing.
An investor watching the news at 2 in the afternoon will be entirely blind to the mechanical avalanche that triggers at 3:30.
So we have mapped the regime. We are in a mathematically exhausted euphoria state.
We have identified the players, algorithmic CTAs operating on a razor-thin sub-1% wire, and a retail base that is actively shrinking its broad structural exposure.
We have outlined the macro trigger. The central bank removing the roadmap, forcing institutions to de-risk due to spiking rate volatility.
And we have examined the plumbing, levered ETFs and negative dealer gamma acting as mechanical amplifiers.
The final critical question is, how does a serious investor position themselves? What is the pain trade the street is currently ignoring?
The consensus across the street continues to point toward a slow grind higher. They view the recent pullback as a standard, healthy dip to buy.
But the OCM PCA 4-week forward data projects a highly divergent reality. Our models project that implied volatility will spike aggressively across both equities and rates.
The VIX is projected to expand, and the MADE index, which tracks bond market volatility, is modeled to rise sharply.
Under these specific conditions of expanding volatility, credit is modeled to crack. We are highlighting proxy widening in high-yield debt, specifically bonds rated BB and below,
as well as investment-grade debt. Now, I have to play devil's advocate here based on the street consensus.
Go ahead.
If the payroll data on Friday was remarkably strong and global growth components are sitting at the 89th percentile, doesn't a robust labor market insulate corporate credit from cracking?
It is a logical assumption, but it ignores the cost of capital. A strong labor market keeps current revenue stable, sure, but credit markets operate on refinancing risk.
Right, the debt maturities.
Exactly. When rate volatility spikes, the cost to roll over existing double B debt becomes prohibitive. The volatility itself destroys the refinancing capability of highly levered companies, regardless of how many people they employ.
The structure cracks before the fundamentals do. So the actionable summary for your portfolio here is clear. You must de-risk cyclical equities immediately.
Our proprietary data shows that broad equity indices exhibit flat to negative forward returns in this specific exhausted quadrant of the euphoria regime. The upside momentum is spent.
More importantly, cyclical equities systematically underperform defensive equities by 0.4% over the subsequent 4 winds in this exact environment.
You simply do not want to hold the assets most sensitive to economic growth when the growth impulse has already hit a statistical ceiling.
Instead, portfolios require a structural pivot. We recommend an overweight position in select commodities to serve as a designated hedge.
Our models show highly asymmetric upside in energy and precious metals during late-stage, exhausted euphoria regimes.
Historically, under these exact mathematical conditions, Brent oil yields an outsized positive 3.46%.
And gold returns positive 0.69%. These are the specific assets that provide structural insulation when the primary growth engine stalls and volatility mechanics take over.
To summarize the core takeaway, the crowd is treating the recent market action as a routine buying opportunity.
But our house view, anchored definitively by the OCM PCA model, flags this as a structural exhaustion point.
It requires an immediate pivot away from cyclical equity beta and toward defined volatility hedges and commodity exposures.
The structural data simply does not lie. When standard deviations reach these extremes across global factors, the system becomes incredibly fragile.
It becomes entirely dependent on continuous, aggressive capital inflows that are no longer materializing in the data.
Which leaves us with a final, provocative thought to ponder as you review your positioning this week.
We have established that retail liquidity is drying up outside of a few speculative, highly shorted pockets.
We know that systematic institutional trend followers are hovering mere basis points above their automated liquidation thresholds.
If those thresholds are crossed and the algorithms begin to indiscriminately sell into a market completely devoid of structural shock absorbers, could this combination engineer a severe midsummer liquidity vacuum?
The math suggests the trap is already set.
See you next week, wherever